So I get a lot of questions on the channel regarding refinancing a loan and what it's going to do to their credit. And this is a big deal because I've actually seen people where they have car loans for, let's say, 6% interest, and then they get pre-approved for 3%, but they don't want to go ahead and take that new loan because they're worried that it's going to hurt their credit score. And this is a big problem because going from 6% to 3% is going to save you so much money, especially if you owe a lot of money on your car. And it really has nothing to do with having your credit score dinged, because eventually your credit score is going to go back up. So that's exactly what this video is going to be about. It's going to be about what exactly happens when you refinance a loan and what happens to your credit score when you actually have your credit pulled when you get a new loan. So the biggest point that I want to get across when it comes to your credit score is that the main purpose of your credit score is to get the best rates possible whenever you're borrowing money or when you're getting credit cards and everything like that. So your credit is used to borrow money for the best price possible, and that is the entire purpose of it. So if your score goes down just a little bit because you're getting a new loan, who cares? Because the whole point is to borrow money for as cheap as possible. So in my opinion, if you have a current loan that doesn't have that great of a rate and your credit score has gone up, then I would definitely consider doing a refinance, even if it's going to hurt your credit score just a little bit, because eventually your credit score is going to go back up. And that's what we're going to talk about next, is exactly what happens to your credit score whenever you refinance or get a new loan. So basically the way it works is that every single time you apply for a new credit card or you apply for a new loan, you are going to have your credit checked. And this is the big type of a credit check. This is what's called a hard pull, and this does affect your credit score, but it's really not that big of a deal and there's no way around it. Because if you happen to be shopping for a new car or maybe a new house, or you just want to get another credit card, there is no way around it. Your credit has to be checked in order to be approved for those loans. And when you have your credit checked as a hard pull, it does affect your credit score. But the way that your credit score works is it's actually a bunch of different categories, and all of those categories have different weight on your credit score. So some of them are considered high impact, others are considered low impact. And whenever you have your credit checked, it's under the new credit category, which only applies to 10% of your entire credit score. So this is low impact and it's not a big deal. So even if you have your credit checked and even if it dings your credit just a little bit, it's just not going to be that big of a difference on your overall credit score, and eventually it is going to go up over time. And another thing to keep in mind is that whenever you have a hard pull, you can actually do this 1 to 2 times every 2 years in order for it to really not affect your credit score, because they consider it good if it's 1 to 2 times, and then if it's more than that, it tends to go down just a little bit, but every 2 years it pretty much resets so that you can get new loans, new credit cards, and it really doesn't affect your score. And then also keep in mind that, for instance, if you're looking for a new car loan and you happen to go to a bunch of different banks and have your credit pulled at each of those banks because you're trying to find the best loan possible, as long as you check all of that within 14 days, that can actually count as just one inquiry on your credit. And that is a big deal, because then you can go to all of those different banks and you can end up with the best loan, and those hard pulls are going to only count as one, and that's exactly what you want. But it's not guaranteed, but that is what they say, is that you have 14 days to do that. And as long as you do that within 14 days because you're car shopping or house shopping, whatever, then it's just going to count as one. So just remember, at the end of the day, if you want to refinance a loan and you are going to get a better rate, then it's definitely worth having your credit checked and having your credit score go down just a little bit to get that money at a better price. Because at the end of the day, remember, your credit score, the whole point of it is to be able to borrow money for the most affordable price possible. That is the whole point of your credit. So take advantage of that and get better loans whenever you can, because if you are going to save money, then at the end of the day, you have more money in your wallet and you can obviously do something else with it. Now, if you just found this channel, I'm Jason with Honest Finance, and I make a lot of videos on different topics that'll give your life and your finances more value. So if you do have an interest in this type of content, feel free to subscribe. But thank you guys for watching this particular video. Have a great day.